I hear my bio being announced, I feel like it seems to indicate that I can't stick at any part of a career. I would like to say that that's not actually true. But without further ado, one challenge before getting into the crux of the presentation, the biggest challenge that the mining sector as a whole faces is one of reputation. And so those of us that aren't in the sector and deal with those that are, my sister actually said it best, because people don't know where their stuff comes from. They're very separated from the products of mining, which are the foundation of life as we know it. And my sister, who is a cultural anthropologist, so politically possibly not aligned with the mining types, but somewhat influenced of her family, she said it best, is that you can choose to be a vegan, but you can't choose not to be associated with the products of mining. So in my little way of trying to spread the message, and a call to everybody that's either directly or indirectly associated with mining to ensure that when you get the opportunity to educate people about what mining is and the benefits that it brings. And this brings me to this slide because I think it's fascinating, because I think us in the mining industry too have this idea that we are very, very large polluters. So this is a summary of the various industries that contribute to greenhouse gas emissions globally. And I think what's fascinating is iron and steel contribute towards 7.2% of greenhouse gas emissions. Let's contrast that to 17.5% that's used in buildings. And interestingly enough, non-ferrous metals, of which the key commodity I want to be talking to about today is a non-ferrous metal, it contributes 0.7%. So this is the cry out to everybody. Let's start getting people aware of what mining is and the advantages that it brings. Disclaimer, read that at your leisure. I will be talking about a couple of stocks. So today I'm talking about the critical commodity and how to play it. Someone just asked me if it was uranium. No, sorry, if you're here thinking it's uranium, it's not. It's copper. And the reason that I'm talking about copper today is copper is the ultimate electrification element. We have almost every country around the globe publicly stating that in this move to net zero, now you can embrace that move or not, but it has some very positive impacts towards the critical commodity mix. And the most critical commodity of all is copper. And this is really what I want to highlight today. So for me, there's a lot of discussion about the demand scenario with copper, but for me, it's all about supply. And I would argue that with many, many commodities is, unlike other industries, there's a very inelastic response to demand-side pressures with respect to supply. And that's because, number one, you can't bring on new mine supply quickly, and so the price can escalate dramatically, and you don't necessarily have a concurrent rise in supply. So copper is at a very, very interesting juncture in terms of where we are in the cycle of this particular commodity. Inventories are at critical levels. This is not new. Everybody knows this. We have declining production profiles, also not new. And I think what's intriguing about this is operating production of primary copper is due to significantly decline from 2025. Now, this shows forecasts for committed, possible and probable, and all show a tailing off in production post-2025. Now, I think it's interesting when you look at the forecasters in our sector, what they do is they take information that's provided by companies. And in our sector, we know most companies overpromise and underdeliver. And so the nature of the beast is they tend to be quite aggressive in timeline. So even these forecasts, if you follow a pattern of forecasting over time, they themselves tend to forecast a higher amount of supply than what actually becomes reality. There's also a lack of commitment on new supply. All new mines obviously require a capital commitment. Large copper mines require a very large capital commitment if they're of size that will materially impact supply. And this is an interesting chart, I thought, that the CEO of Glencore which shows that from 2025, now this is committed capital industry-wide, 2025, despite the fact that we know there is a material decline in copper production coming, that 2025 committed expansionary capital is 61% below its peak of 2012. This is pretty material. And of course, fiscal and geopolitical uncertainty. Mining is a dirty word. Nobody wants it in the backyard. And we have this confluence of events where we've got government saying we need new critical supply of mineral and saying positive rhetoric and not necessarily following through on the other side. And perhaps the most recent example of that is the US government for tailing Antofagasta's development of its twin metals mine in Minnesota. And how they have stopped that is simply by changing land designation. Now, this is after Antofagasta Minerals, Antofagasta, a very large Chilean copper producer, has invested plus $400 million in studies, etc. And also this mine is an underground mine, so very low surface footprint, and the tailings would be dry stack, which is the safest and the lowest environmental impact dry tailings. And so if we look around the world, political risk isn't going away. Now, that's very frustrating if you're exposed to a company, First Quantum recently, obviously, a lot of noise with Cobre Panama and what's going on with the government wanting to take more and more out of that asset, is that wherever you are in the world, there's political risk. It can just manifest itself in different ways. I thought this was a really interesting chart because this shows copper projects that have been sanctioned since 2007 in terms of the impact to millions of tonnes of copper. And ironically, there seems to be an increase in copper projects being sanctioned when copper prices go up. Now, maybe that's because governments start to go, okay, I can get more tax revenue, I can get more fiscal, and so they want to start changing the goalposts. And obviously, those of us that are on the other side of it, either as investors or majors who are putting material capital in the ground, don't like those goalposts being changed. So on the supply side, everything points to a multi-year structural deficit that is probably looming closer than anybody thinks. And I think the best analog to this is what we've seen in the lithium market. I think that every lithium market pundit for the last 10 years has been saying that there is a structural shortage of lithium supply. There is not enough supply to meet base case demand, let alone accelerated demand associated with electrification of vehicles, etc. And it took a 9-fold increase in the lithium price over the last 2 years to result in material commitments to increase lithium production. So just a little touching on the demand side. And again, you can agree with net zero or not, but the key takeaway here is we are voluntarily globally, we are increasing our cost of energy. So we're increasing our cost with a move to net zero, and we are increasing the cost of our imports. And if we are going to move to net zero, the amount of new copper that needs to come online is very, very material. And in fact, numerous pundits say between now and 2030, that's not that far away, 7 years, there will be a 4.7 million tonne shortfall in primary copper supply. Now, to put that into context, that's essentially a quarter of current global supply today, and it will take $100 billion of investment to bring that supply online. That investment is not occurring in the current copper price regime. So where is copper in terms of where it sits in the copper commodity cycle? So I'm somewhat biased. I'm obviously talking about copper, but I would say that we're at the bottom of the cycle with a very, very strong probability for increased prices, which will then percolate down into what we're probably all interested in, which is what will happen with the underlying equities. Now, if I look at lithium, I would say lithium is more advanced into cycle. We have had that massive price increase, and we have incentivized a lot of new production. And so let's talk a little bit about incentive pricing. So yes, if you're a copper miner today in the current copper price environment, despite the inflationary pressures that we're seeing and despite probably a global propensity towards increased taxes and royalties, you're still seeing decent margins. However, the current copper price, it is not enough to incentivize new production because new production requires material capital investment and companies need to see a return on those dollars invested. And maybe a leading indicator of why we're not seeing new production is, again, pointing to Glencore, confirmation bias. But Glencore's CEO, I actually think, is a leader, not just in copper, but in mining industry in general. He has come out and said, no, we are not bringing on any new supply. We can, but we are not bringing on any new supply until the market is literally screaming for us to do so. And that screaming will express itself in the underlying commodity price. I would say in the past, our industry has been very, very good about bringing supply online at the worst possible time. We want tension in the price. We want the copper price to go up. So just touching on how does this then play into how do you invest in the sector, I think the four most dangerous words in the English language are this time it's different. It's never different. Corporates and investors are doomed to replicate the same behaviour time and time again. Predictably irrational, as a very famous book has described it. And if you understand the predictability of this behaviour and then invest accordingly, you can increase your chances of outsized returns. So if we look through a commodity cycle and corporate behaviour, prices go down, bankruptcies occur, there's asset sales, capital conservation occurs. Investors are very unhappy. Many of them have experienced very poor share price performance. They are demanding capital allocation discipline, which means no growth. Now, this is when the savvy resource investors start to nibble around the edges. None of us pick the top or bottom. If we say we do, we're lying. But this is, you're closer to the bottom than you are to the top. Then as the cycle continues, prices start to rise. We start to see a willingness to indulge in slightly more risky behaviours. So increased M&A, but low-risk M&A. A recent example is BHP Minerals acquiring the large copper producer Oz Minerals. Well, it hasn't completed, but announced that acquisition. So it's a producer acquiring a producer in a jurisdiction they know, low-risk M&A. Capital becomes more available, and so capital becomes more available, share prices go up, people start spending more money, and this is where people would start to say, well, you're at the beginnings of a bull market. That capital is deployed, we start seeing new discoveries, this is what happens when you actually spend some money, and then we start seeing higher risk behaviour. We see new IPOs. If we again point to our recent experience with lithium, we have seen a proliferation in lithium companies in the form of new IPOs, and then those fly-by-night juniors who are uranium or crypto or cannabis 1, 2, 3 years ago, and hey, okay, lithium's the next greatest thing since sliced bread, I'm going to hop on that bandwagon. Growth begins to matter. Suddenly investors are demanding growth, and CEOs' KPIs are predicated on growth. And then we start to see high-risk behaviour. So ironically, we tend to see companies decide they want growth. The easiest way to grow your business is to acquire an existing asset, not go through that hard work of putting high-risk exploration dollars with which there's a long duration to ultimately becoming a mine. And this is when generally the generalists are hopping in. They've been hearing about this thing called lithium. And they've been hopping in now, and speak from direct experience. I am involved in some expert networks, and whenever I'm asked to talk about something on mining, it's in lithium. And it's by people who are smart but don't really understand mining. And so if people are just starting to do the work on lithium now, when we've seen this exceptional price rise and underlying equity performance, I would argue you're closer to the end of that cycle than the beginning. And this is where the savvy resource investors are beginning to sell. And of course, that's a bear market, and then the whole cycle starts again. So in terms of how I look at individual equities and trying to make smarter buy decisions, I make mistakes, we all do. I would say the key is not just buying, it's also knowing when to sell, and probably being greedy but not too greedy. So we've touched on the cycle. Where you are in the cycle is very, very important. If you're in a rising commodity price environment, you don't have to be that smart. Pretty much everything will do very, very well because companies react to their underlying commodity price and will behave accordingly. But for me, when I look at companies to invest in, people is the most important criteria. A good management team can create enormous value out of a mediocre project, and a very poor management team can destroy value in a good project. Of course, the quality of the project is very important. Is it real? That's important to me, although you can have companies that will perform well just because of market sentiment on I would say, not a good project, or in Australian terms, a crap project. So is it in a good place? Is it in a place where your impediments towards advancing that project aren't fatally flawed? So is it a mining-friendly jurisdiction? Are there tax and royalties that won't destroy your value? Is there communities that are on side? Is there water? Can you access water? Less important at the early stage, but very, very important as you advance through the development cycle, is what is your available infrastructure? Is there abundant available infrastructure? Because that dramatically decreases your cost of capital. Place, touched on place again. Place is very important. Risk profiles change over time. Sometimes one place is great. In a couple of years, it may not be. So be aware of the general overlying political risk conditions. Strategy is really, really important. And your strategy has to be dictated by where you are in the commodity cycle. So if you're a junior company, how you fund your business is through the equity markets. And so you want to see management teams that are making decisions that are predicated on, will this create value? i.e., will my share price go up and will I hopefully raise at a higher price? We sometimes see management teams with this insistence of driving forward at all costs. Okay, I was an explorer and now I have to be a developer. You know what? You don't. Really, sometimes it's best to just step back and go, we have a great asset. The commodity price is not favourable towards us right now. So why would we spend dollars that are not creating value per share? Promotion, bit of a dirty word, but there are literally thousands of companies out there that are competing for limited, finite investor attention and a finite supply of capital. So you might have the best idea or have the best asset, but if nobody knows about it, how do you get buying pressure into your company? On the flip side of that, some companies are all promotion and no substance, and maybe you'll make some money in the short term, but what we want to see is some money making over the long term. Cost of capital, this is just really intimately linked. Ideally, those companies that are highly valued, that are trading at a premium to their underlying value, they understand that and they issue equity. It's the most accretive action you can take. That is, issuing equity is not always a bad thing. And then catalysts. What are the catalysts that are going to drive share price performance above and beyond their movement to the underlying commodity price? So what causes share prices to move? I know this might seem pretty basic, but I think it's really worthwhile reflecting on. So again, if we're in a rising commodity price environment, and I think we're in a structurally sound position with respect to copper, anything that's exposed to copper, or has copper in their name even, will tend to move in an upwards trajectory. However, what we're looking for are alpha-specific events. That's non-company-specific events that will help drive the share price above and beyond their movements to the underlying commodity price. I think we're all invested in the junior sector for these outsized returns. It's unique. One drill result, one piece of information can result in a share price moving plus 100% in a day, plus 1,000% in under 6 months. No other sector has quite these returns. Obviously, it's the one we're all aware of. Takeovers. If we start seeing takeover activity, a lot of takeover activity is normally, to me, a sign that you're nearing a bit of a toppy part of the market. But then again, takeover anticipation, that results in share prices re-rating. And obviously, when a takeover occurs, there's normally a premium involved in that. Named investors. I think you'll probably listen to Rick Rule and other very famous investors. When their name is announced as being associated with a company, it's probably somewhat irrational, but the share price commonly moves upwards. People in promotion, we touched on that. Sometimes just simply a re-rate occurs because people become aware of the company. And of course, political risk changes can work in your favour and against you. So how do you play copper? 3 main groups, the majors. And so what we have here is copper price on the bottom, share price performance on the left-hand axis, and risk on the right-hand axis. So majors are your lowest risk way to play, but you're also going to have the lowest share price performance to movement in copper price. Mids, a bit more risk and a bit more torque. And of course, juniors, near and dear to my heart, where you have the most performance, the most outsized performance. It's easier for a $100 million company to go to a $1 billion company than it is for a $1 billion company to go to a $10 billion company. But of course, with that outsized return becomes outsized risk. And it's the same with alpha events. A junior can move on a single drill result. It's pretty rare for a mid-sized company or a major to move on a single drill result. So just wanted to point out, this is some mids, but what I thought was intriguing here, and I am exposed, not unbiased here, but Americo, it's an interesting one. There's a valuation mix match. It's a sizable producer. They reprocess tailing and a very, very hefty dividend. So small companies, some torque, but on the lower risk profile. On the juniors, again, near and dear to my heart, these are talking about how to fulfill the supply gap. These are the companies that have sizable development projects that could be in production in the next 5 years. Now, one I just want to highlight, again, not an unbiased participant. It's my largest personal copper exposure. I've been buying heavily in the market, and I'm also chairman of Hot Chili. It recently became listed in North America, which is more of a natural exchange. Its primary listing is in Australia. Sizable asset, low elevation Chile, great management team, but it's relatively unknown and is trading at very, very low valuations. And that's it from me, and I think I've used up my time.